Hey folks, welcome to a product review at Finominal. Today we're going to look at DoubleLine's Shiller Enhanced Cape Fund, which trades under the ticker DSEEX. The fund manages more than $3 billion, charges 55 basis points, and has an interesting strategy. It provides exposure to fixed income as well as equities, and effectively represents the leverage product because 100% allocation goes to fixed income and an additional 100% allocation goes to equities. Within fixed income, the asset manager, which is DoubleLine, so that's a fixed income shop, allocates to bonds across asset, bonds globally, effectively, right? Selecting the securities that it finds most favorable. And for the equities portfolios, it uses a sector rotation strategy within the US based on Shiller's Cape ratio. Now, it's not just simply selecting the cheapest US sectors. There's a little bit of what you could characterize as a momentum overlay to avoid value traps. So for example, the cheapest sector is typically excluded. So let's investigate in terms of how this product was done and if it offers anything unique to investors. We're going to kick off with a short breakdown by assets analysis. And if you simply look at this holdings analysis and as benchmark, I'm going to switch to the S&P 500 because that's also what we can find on the fact sheet of DSEEX. And this holding space breakdown by assets shows actually like a 0% allocation to equities of the DoubleLine Shiller Enhanced Cape Fund, and well, almost 100% allocation to fixed income. Now, that's probably because the exposure to equities is done via swap, and most of the data providers, including ours, are not particularly good at showing the exposure to asset classes or instruments via swap. Having said that, if we switch to a risk-based allocation by using returns, then effectively we can see that almost all of the risk can be attributed to equities and not to fixed income. So that's kind of interesting. We can continue to dig a little bit more into that by doing a returns-based factor exposure analysis. And again, over here, we do see this consistent beta of close to 1 to the S&P 500, while seeing almost no exposure to, well, an investment grade bond index. We do see a slight negative exposure to the US dollar index, which simply highlights that there's been exposure to international bonds for time. If we switch this to like a risk sources analysis, we do see that almost every year, right, it's effectively the equity market that dominates the risk of that. We can see hardly any bond exposure. Now, that's one because equity is more volatile than bonds, right? But it also depends on the type of bonds. So, for example, if this portfolio includes exposure to a high yield, then that tends to be more viewed as equity risk because high yield is somewhere between bonds and equities. It's also worth mentioning that a returns-based factor exposure analysis, like this one, right? It's not particularly good at measuring short-term T-bills, right? So that's also something to keep in the back of your mind. So this is from an asset class level. Now we do know that for the equities portfolio, effectively sectors are selected that have low valuations, right? The ones that have lower, well, cyclically adjusted price earning ratios, right? And so we would expect a positive beta to the value factor. Having said that, if you look at this equity factor exposure analysis, well, over the last 10 years, we don't see any exposure to the value factor. In fact, there's no significant exposure to equity factors at all. It's time varying, which is slightly perplexing. Now that's in terms of looking at the portfolio. The other aspect we can do is look at this portfolio from risk perspective. Now, as mentioned, it's a leverage product that has 100% allocation to fixed income, 100% allocation to equities. And so you could expect, given that these asset classes most of the time are negatively correlated, or at least for the last 10 years, right? Except perhaps in 2022, that the drawdowns of this fund would be less than that of the S&P 500. Having said that, we can look at the drawdowns over here, and we can see that the drawdown, well, during the COVID-19 crisis in 2020 was actually worse than S&P 500, and also in 2022. So that's kind of interesting to think about. If we move away from risk and we move to performance, so we do have a track record over the last, well, 12 years, but there's very little differentiation to the S&P 500. We do see an outperformance from 2014 to 2022, and that's of course when bonds increased in value, versus in 2022, bonds, when effective interest rates started going up, right, started declining, and you can see the outperformance turning into underperformance. And so with the entire track record, right, you can see actually that this product has underperformed the S&P 500, which, as mentioned earlier, is one of the benchmarks on the fact sheet of the fund. Now, making this slightly worse, you can also see that the volatility of the fund was higher, drawdowns were worse, and the Sharpe ratio was significantly lower than of the S&P 500. So that doesn't look particularly good for the fund. And the final question that we asked ourselves is, can investors, if they kind of like the structure, can they replicate it? Because there are leveraged ETFs out there, and the short answer is yes. So we created a simple portfolio comprised of roughly 50% allocation to a leveraged S&P 500 ETF, I think 30% allocation to a leveraged US Treasury ETF, and the residual just to T-bills. And you can see over here, right, you get pretty much the similar performance. The Sharpe ratio and the return of this replication portfolio was actually higher over the time period. So if you replicate it, you simply need 3 instruments to do so. And this concludes our short analysis of DoubleLine's Shiller enhanced CAPE ratio. As mentioned, this is a complex portfolio. It's an interesting one, but it hasn't created any real value compared to pure equity exposure or even to such a simple replication portfolio. Hope that helps. Have a nice day.